When gold and stocks fall together, it's a red flag. Here's why. If you've been watching the markets lately, you may have noticed something unusual and alarming. Gold, that classic safe haven, is falling right alongside US stocks. When that happens, it's not just a pullback. It's a signal that something deeper is wrong, and your wealth could be quietly eroding, even as 90% of investors remain unaware. What we're witnessing isn't normal. It's the kind of synchronized sell-off that often precedes a full-blown financial crisis. A rare and ominous pattern. Recently, spot gold fell more than 2% in a single day, hitting a fresh low. At the same time, the S&P 500 extended its losing streak, led by a broad tech rout. Even Bitcoin wasn't spared. It broke through key support levels and erased all its gains for the year. When these three major asset classes fall in unison, it's historically been a sign that deeper trouble is brewing beneath the surface. Why this time is different and more dangerous? The real cause for concern. Gold is supposed to protect you when stocks fall, but when gold itself loses its safe haven status, it points to a liquidity crisis. Investors aren't rotating into safety. They're selling everything they can, at any price. As one expert from futures brokerage Altavista put it, this is a classic liquidity squeeze. People aren't selling because they want to. They're selling because they have to. We've seen this movie before. Before Lehman Brothers collapsed in 2008, gold fell alongside equities. In March 2020, at the peak of pandemic panic, gold plunged 6% in a single day. On both occasions, markets were gripped by the same dynamic, a desperate scramble for cash. But the situation today is even more complex. Small orange diamond tech bubble risk. Michael Burry, the real-life Big Short investor, recently announced a high-profile short on AI stocks. It's a wake-up call. After years of soaring on hype, tech valuations have become completely detached from reality. If that bubble bursts, the fallout will be severe. Small orange diamond corporate debt stress. After repeated Fed rate hikes, refinancing costs for U.S. companies have surged. Junk bond yields have now topped 9%, meaning many firms won't be able to afford new debt. Rising defaults could easily become the trigger for a broader crisis. Small orange diamond, a more interconnected system. Unlike 2008, which was largely contained within the banking system, today's risks are spread across tech, crypto, private credit, and more. If these bubbles pop at the same time, the impact will be far harder to control. What this means for your money. In this environment, traditional investing logic breaks down. Gold may remain suppressed in the short term, not because it's not valuable, but because liquidity is what's truly scarce. US stocks, especially high-flying tech names, remain vulnerable. Cryptocurrencies, often the most speculative assets, tend to get sold first and fastest. The big picture shift. What we're seeing may signal a fundamental reshaping of the global economic landscape, from the stability of the dollar system, to the future of tech, to the restructuring of supply chains. Market volatility may just be the surface expression of much deeper changes. The bottom line, there's no such thing as a permanently rising asset, or a perfectly safe harbor. Understanding market cycles and the true nature of risk is the only way to stay grounded when everything seems to be falling at once. It's still unclear how this crisis will ultimately unfold, but one thing is certain. When gold and stocks fall together, the market is sending a clear warning. This isn't a routine dip. It may be the start of a major reckoning for the financial system. Throughout history, financial crises have rarely been random. They're often the result of long-building imbalances, finally correcting in violent fashion. This may be one of those moments. The storm isn't coming. It's already here. Are you prepared?